Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner and co-founder of Galileo Capital. Warren, good evening to you. And tonight you want to focus on how to be a successful long-term investor. And I imagine the operative phrase in that is long-term.
I think it's almost the only way to be a successful investor, Stephen, is to actually try and separate yourself from the madness of the crowds by focusing on things that you can control and try to ignore, if you can, the distracting kind of noise that gets created around market movements over very short periods of time. You know, I think I just keep thinking when we're looking at the rand, I know it's whatever it is today, 17.30. I think a lot of people would have been really surprised, if we'd gone back 2 years ago and looked at the rand when it was testing levels of nearly 20 to the dollar, and all of a sudden it's at 17.30. It would have surprised a heck of a lot of people. And I can't keep thinking about how many people were just sending money, out in droves overseas because they just were almost forecasting the end of our country. I think the phrase failed state was used a lot by investors. And just look at us now. The JSE is breaking all-time highs. The rand is strong. The economy is not doing as well as we want, but the market is doing well, and business sentiment is improving all the time. And just shows you that 2 years is a heck of a long time for people that are trading and speculating, but for a long-term investor who had a long-term focus, this would have been a blink of an eye.
Sure. Okay. So some fundamental principles, and one of the first things you want to talk about is how you define your time horizon. I suppose how long you're investing for.
Exactly right. So a lot of people, when you talk to them about growing their money, they just say, "I just want to grow my money." And that's great. We all want to grow our money, but that's a bit like saying, I want to go on holiday. And then when you ask them where they want to go, they go, well, anywhere. Well, that means you're pretty much going nowhere. You have to have a clear destination when you're investing your money, and a destination in this case is a time frame. So if you've got very young children and you want to save for their schooling, or maybe high school or university, then that's a clear time frame. It could be 7 years or 12 years or 13 years. And that helps you make some very sensible investment decisions, because you're now saying, if I've got another 13 years to go before I'm going to need this money, I'm not too worried about what's going to happen to the stock market or the rand or whatever it is over the next 1 month or 3 months or 6 months, whatever it is, because you're not worried about that. You're worried about 13 years' time. And then all the noise that gets created by investment markets booming or crashing, you can pretty much ignore. And I think it's the thing that we have as an advantage as private investors over all the big professional investors out there. Those money managers that are looking after pension funds and unit trusts. They can't define a time horizon because they can't decide when everybody's going to put money in or everybody's going to take money out. And we can do that. And so I think defining your time horizon, is probably a superpower, I'd like to say. I don't think it's an exaggeration. If you can set a time horizon, and then most importantly, don't do anything to change your time horizon once you start. So if you're saying 13 years, the investments that you should be making are largely going to be in the stock market, because that's a very long time frame. And then don't worry about what the markets are going to do in the short term. Just keep adding and keep saving, and that will get you your investment success over time. Don't worry about what's going on day to day.
And then obviously setting clear investment goals. I suppose what you're going to use the money for.
What you're going to use the money for and why. I think it's difficult sometimes to maintain course. There are always good reasons why we need to draw on our money. If we just look at all the news stories around people drawing on their retirement funds in this new two-part system, there are good reasons why people are drawing their money, but some people aren't. Some people are just drawing the money and not necessarily using it very well. And the reason is they don't have very strong motivation or motivated goals for their money. So again, looking at what will motivate you and what will help you stay the course with your investment strategy. So it's slightly different from setting a time horizon. Now it's about saying it's meaningful to me to invest for my child's education. That will enable me to not draw on that money and go and buy myself a new car instead of setting aside a university fund. Or I watched my parents work until they were 85 because they never had enough money in retirement, and I never want to do that, and I never want to expose my children to that, and therefore I will save for retirement. So it's being very clear in your mind as to why you're doing these savings goals or these investment goals, and then using that motivation to help you stay disciplined and committed to your goals when it's very tempting to draw on the money for other short-term reasons.
I suppose just to have the goal is the important thing, and then obviously your portfolio, you've got to diversify that.
I think we're probably going to talk about diversification for the rest of our time together, Stephen. And I think it's so important because it's the one thing that will get you through the bad times. If you've got a 13-year time horizon, just to stay on that as an example, that means that you should be investing in a broad range of shares. You can do it in an index or a unit trust, and you should be investing in South Africa and overseas. And the reason for that diversification is you just simply don't know what's going to happen to the world and to stock markets over a 13-year period. What I can say with confidence is that if you're investing mostly in companies and mostly in shares, that you can back the management of those businesses to do what they do, which is to grow and adapt to the environment. And so you need to stay invested, and you need to make sure that you can spread your risk so that if you own a share, let's say a Steinhoff or an African bank that blows up on you, it's not going to be catastrophic to your position because it's only one of very many investments that you hold. And I think if you've got a long time horizon, the other secret here is set a nice diversification goal for your portfolio. Make sure that you mostly invested in shares, but also allocate some money to property companies, to some cash and to some bonds. And when those do well, you'll benefit. And when one or two of them don't do well, that'll be okay. And I'm just looking at what the latest stats from the sectors in South African stock markets, and surprise, surprise, it's the property sector that's leading the way with a return, I think, of nearly 50% over the year. And that's astounding when you consider how much property companies have taken pain since COVID. So again, we wouldn't have been able to predict it, but if you have a nice diversification in your portfolio, you'll be benefiting now.
And then in terms of strategy, you say you need to do a buy and hold strategy. In other words, you need to hold on to stocks for some time.
We can't predict. We're terribly designed as human beings to be very good predictors. We can't even predict the weather accurately. So how on earth we can predict what the direction of stock markets will be over a 1 or 2 year period, or what the currencies are going to do, or what's going to happen with the advent of AI and whatever the new thing will be. And so if we're not good at predicting, we need to be humble enough to say that's not our superpower. And what we can do is we can set a goal and be a buyer of investments, whether you're investing as a lump sum or as a monthly amount. Just give yourself the goal that I'm going to buy and I'm not going to sell. When someone asked Warren Buffett, who I think is possibly the most successful investor of all time, how many times should I trade my portfolio in a year? He said 5, but then he kept quiet and he said 5 times in your life. And people thought he was joking, and he wasn't. He doesn't sell shares in his company, Berkshire Hathaway. He holds them for very long periods of time with the idea that they will deliver growth for him if he just continues to hold in all market conditions. And I think we can learn from that.
You also say, though, that you should review your portfolio. So how do you review it if you adopt a buy and hold strategy?
So what we're worrying about here is if we've said, okay, we've bought this diversification argument, and I think that maybe 40% of my investments should be in the JSE, 40% should be in the global stock markets, and the balance should be spread between cash, bonds, and property. Then what you need to do is, and I don't think do it very regularly, but I think once a year is very good, is just to see that balance is being maintained. So if the local stock market is starting to do incredibly well, and the international market maybe is not doing so well, you might find that 1 year from now, the local side of your portfolio might be at 60%, and the international side of your portfolio might only be at 20%. And the trick there is be disciplined in reallocating that money, because what you do in a strategy like that is you end up selling investments that are probably a little bit expensive and buying the investments that are a little bit cheap. And it forces a discipline on you to do what's unnatural, because most of us don't like to buy investments that are busy going down. In fact, we just want to sell those and keep buying more of the thing that's going up. The problem, Stephen, is that the thing that's going up is getting more and more expensive, and the thing that's going down is actually the one you want to start buying, because that's the one that's cheap and that's the one that's going to deliver you growth. So by reviewing your portfolio on an annual basis, you're not trying to trade and you're not trying to predict what's going to happen. You are being a buy and hold investor, but you're ensuring that that diversification that we've spoken about is maintained, and a straight discipline in terms of having to ignore what's going on in the world because you don't care. All you're worried about is your goal and your desired allocation, and is it still correct for you?
When you do that review, is it a good idea to do it with someone? I mean, not necessarily a professional, but what I'm saying is have 2 or 3 minds in the room rather than just one.
I mean, I think it's an absolutely brilliant idea, because it's very hard for us to be unemotional about our money. And, when the world is so uncertain, there's conflict all around the world, we can find so many reasons to become overly fearful, overly pessimistic, or equally, when things are going particularly well, we might become overly optimistic. And having a sounding board that you trust, and someone that's going to be objective with you, helps you to just be accountable for the decisions that you've made, and make sure that you continue to stick to those decisions. So in a review like that, I mean, what you could easily do is sit down with that person or 1 or 2 people and just say, let's form our own little, almost like a stokvel. We're not going to pool our money together, but we're going to agree the goals, and each of us are going to set our own goals. And once a year, we're going to get together and we're going to say, this was the goal I set last year. This is how it's going. This is what my portfolio looks like now, and I need to change it. And if you're changing it, you have to explain the reasons for that change to the other people in the room, and let them interrogate you and make sure that you're doing it for the right reasons. And because it's not their money, and hopefully it's people that you've chosen that will like you, they're going to hold you to account in the right way for the decisions. And peer pressure can be a wonderful thing if you use it correctly to help you stick to your goals and stick to your disciplines. That's why we have running clubs.
Yes, I suppose so. And what would the world be like without them? Warren, we've actually got a couple of questions for you coming in. John in Cape Town's asking, my late mother left me a sum of money. She wanted me to use them for my children's tertiary education. He would like to know more about the most tax-efficient method to transfer the money to them. There's also a question this evening about what happens when you want to take control of your elderly parents' finances and how difficult that is. We'll put those questions to Warren Ingram for you in just a moment.
The Money Show. Personal finance with Warren Ingram.
So, Warren, the first question comes from John in Cape Town. He says, my late mother left me a sum of money. She wanted me to use that for my children's tertiary education. My children are 17 and 20 years old. There's sort of 2 parts to this. What is the most tax-efficient method to transfer the money to them? Should I simply invest the money on their behalf, pay the tax on the income at 40%, pay for their education, then donate any remaining money to them when they graduate? Or is there a more tax-efficient manner that can be used? And the second question is the best investment vehicle for the money, so retail bonds or unit trusts, given the short time horizon and the well-defined payment intervals. In other words, university payments would be made in February and June for the next few years. Warren, I don't know if you can help on that, and particularly the tax-efficient method to transfer the money to them.
It's a fabulous question, Stephen, because I think a lot of people will have that focus on trying to be tax efficient, and then maybe they're missing the wood for the trees. The real trick here is understanding that your time horizon is phenomenally short. So if you've got a 20-year-old, I'm assuming that your 20-year-old might already be going to university in now or next year, and so you've only got a few months to go before that first payment is required. And so, the most important thing here is not overexposing the investment to something like the stock market, which, could be going, could go up by 30% by February, but equally it could be down 30% by February. It's such a short time horizon that actually what you want to do is you want to buy certainty. In other words, go for something that's incredibly low risk, and that would be some kind of of a money market account. I don't think a fixed deposit makes sense unless it's a very short-term one, and then do the payments for your children's education from that money, so that you've got a defined expense at a defined time. And yes, you'll pay some interest, tax on that interest, but remembering that you are allowed to earn a certain amount of interest every year before you pay tax. And equally, I mean, the other, and I think this is always a genius idea, is if you've still got a mortgage, John, the thing to do is store that money in your mortgage, because that's tax-free and you're saving a huge amount of interest, that you would be paying. And you can do a calculation to make sure that you're not doing your kids in with the interest that they should be earning from you, and then pay out their fees every year. And if there is money left over, help them set up an investment account and try and coach them along the way so that they don't go and spend that money.
Okay, so you could take, if the mortgage is still going, you could literally put the money straight into your mortgage and pay them out, and there would be no tax on that at all.
No, I mean, it's such a wonderful investment. We know our interest rate on our mortgage. It's, and so let's say you're paying prime. I think nowadays prime is 11%. So that's the equivalent of a tax-free guaranteed return on money, because every cent that you put in that's extra in your mortgage is saving you 11%, and it is tax-free. And so when you need the money, you can draw it out. So just make sure that it's an access bond. Make sure that you can get the money when you need it. And I think a lovely way to help your kids and to keep your bond as under control as possible.
Sure. And then a second question. Good day. I'm possibly going to have to take control of my elderly parents' finances, and I'm nervous about overstepping. How do I handle the transition? Sure, very carefully, I suppose. It's the first response.
You took the words right out of my mouth. I think you need to understand that this is not really a pure personal finance question, because the psychology here is really important. When people are elderly, I'm assuming that you're doing this because you're worried that that they might not be able to make the best, most rational decisions anymore. Maybe there's some mental health issues, or just simply a form of dementia or something like that. We don't know. But when you do this, you have to be very clear and very transparent with your parents to say, I think it's time that we get involved, that we try and help you, especially to avoid mistakes. But very often what happens in a situation like this is that adults, children create a sense of helplessness with their parents. So the one thing they do is they remove their sense of independence, and the ability for them to control their own destiny. And so we almost, as adult children, turn our parents into children again, and we try and give them pocket money and try and control their lives. And we might be doing it with very good intent and very good, well-meaning intentions, but actually what happens is you make them feel completely powerless, and they've spent their whole lives looking after you and themselves, and suddenly, in their golden years, they're now feeling trapped by their children, and it does cause enormous conflict. So I think if you can have the conversation with them, again, we spoke a bit earlier about having conversations with one or two other people at the same time. So don't be afraid to bring in a trusted friend of theirs that that can help you have the conversation. But I think you do this very carefully and maybe step by step, where you don't just take everything away from them at once. That can cause the opposite effect, where they just don't talk to you and they take control of their money, and potentially to their own detriment.
Sure. Yeah, very, very difficult. When you talk about investing over the long term, one of the things you talk about is understanding your risk tolerance. And I mean, that's very important. And I mean, everybody has a different risk tolerance. I would like to think that over the longer term, and you're investing for yourself and for your children, you kind of don't want to have much of a risk tolerance, but risk does matter in investing.
Absolutely. Saying to someone that, you should have, using the example I used earlier, where you take 80% of your 13-year money and you put it in local and global stock markets, and you spread the rest across cash, bonds, and property. That's all good and well, but if the person that's making the investment decisions will start to develop a real sense of fear and panic when the stock market goes down and they start losing more than 5%, what will actually happen is that they will make some really bad investment decisions. So even though on a rational level they know that they're long-term investors and they know that they should stay invested, some people just don't have the psychological tolerance for big losses, and it causes them to make the most irrational decisions that they will regret deeply later on once they're calm again. But it's a pattern and a cycle that we see repeat time and time again across thousands of people, right across the world. And unfortunately, it's got nothing to do with your education, your financial literacy, your relative wealth or not. This is something that's a deep-seated emotion, much like a fear of snakes or a fear of heights. So it's important to know what you're going to do if your portfolio goes down. If you can tolerate a decent loss and you understand why and you're not going to panic, by all means, allocate a large portion to the stock market. But if you are going to panic, you need to find a much lower risk investment that will allow you to stay invested for the long term.
And then obviously within all of this and all of the decisions that you have to make, you have to try and keep your emotions, you've just been talking about them, you have to keep your emotions as far away as possible.
Yeah, and I feel that there's this horrible phrase called FOMO, fear of missing out, and I don't know who coined that phrase. I wish it. I mean, it's valuable in one way, but if we just think about the cryptocurrency craze of a few years ago, maybe the AI, craze of the last sort of 18 months, people they're so afraid of missing out on the next big thing and of not being able to double their money in a very short space of time. And so we can get hooked by being overly optimistic and kind of caught in the hype of investments. And usually what happens is we buy something just before it implodes and costs us an enormous amount of money. So in this instance, control your emotions. Don't worry about what everyone else is doing. This is not a horse race. This is you running your own race according to your goals and your objectives, and just ignore everybody else.
Good advice for so many things. Warren Ingram, thank you very much indeed. Personal Finance Tonight with Warren Ingram, the co-founder of Galileo Capital.